I think of myself as both a long-term investor and something of a short-term. In my long-term is the next 20 years, even though I probably won't live 20 years. And my short-term is the next 3 years. And I compare it to a mile run and also a marathon. So you have two different strategies that you employ in a mile run and a marathon. In a marathon, you can fall down and get back up and still win. In a mile run, probably not, unless you're awfully quick getting up. So with that in mind, I can't make many mistakes on the mile run in my 3-year investment portfolio. So I have to be very accurate. So what I'm looking for, particularly because I'm investing in AI and the AI revolution, I'm looking for the stocks that are going to give me the greatest return on investment, the greatest increase in earnings per share over the next 3 years. And I do not care who their CEO is. I do not care what their connection to Donald Trump is. I don't care. All I want is over the next 2 years, whose price is going to go from where it is today to where it is on January the 1st, 2028, and give me the greatest rate of return. So in order to do that, I've got to take all the fluff out of it. Now, what is the fluff? In my mind, that's the PE ratio. Such as Palantir right now has a PE ratio of 200. So what that's saying is the current investment public is willing to pay for 200 years of its earnings in order to get the price of the stock it's selling for today back. Well, that sounds silly to me. Whereas on Micron, the PE ratio is substantially less. And so I see that Micron is in the same business as in semiconductors. And so I'm only interested in who's going to give me the best price over the next 3 years. So what I've done is I've brought the spectrum of 6,500 stocks that you can buy in the United States on the various exchanges. I brought it down to about 55. And I've said, okay, from my research, these are the stocks that are going to be the major players in both the building the infrastructure of the internet and then or the infrastructure of AI, and then also the delivering AI to me in the form of some form of software or AI agent, and that will probably happen in the second 3 years. But in the first 3 years, it's going to be the people building the chips, making the chips available, supplying the burn and the packaging for those chips. It's going to be the people who are building the infrastructure. Okay, so in the 3-year spectrum, I need to identify the companies that are going to give me that greatest rate of return. So what I do is I've created a new algorithm where, in essence, I say they all have the same PE ratio. All I want to know is how much are their earnings per share going to grow between today and January the 1st, 2028. Now I compare them and say, that's where I want to be, where the biggest growth is. I take all the fluff out. I don't care who your CEO is and how connected he is politically. I don't care about that. I just want money returned. So I analyze them. Actually, I analyze the stocks in 4 different categories. Let me show you the sheet that I have created and show you how it works and show you where I have it so you can access it on a daily basis on my website. So as the numbers change, you can see how they rank relative to each other and where you're going to get the biggest bang for your buck. I'm reading this book. It's called The Edge. It's written by a poker player, a professional poker player, and he explains that when you sit down on the table, you need to know who your opponents are. You need to know their history. You need to know how they react to certain situations, and then you make you create a calculated risk. Like he says, everything is predictable if you've got enough data. And I think I have found the sources for the data. I've shared with you, I pay over $20,000 a month for this data. And then I'm building the algorithms to analyze it. so that you and I can make better investment decisions. And it's happening. If you know, if you've been watching, you know that I've been beating the drum for AEHR for probably a little over a year. Today it's up 24%. Why? Because it's going to grow its earnings faster than Apple or faster than Palantir. That's why it's up. Let me show you this. Okay, here is my latest spreadsheet. I'll tell you up front, this isn't going to be easy because there's about 20 years of knowledge that goes into here. What I've decided to do is, if you've been with me anytime, you know that I believe the best investment opportunity of my 80-year lifetime is in front of me right now as we move into artificial intelligence and the delivery of artificial intelligence to the general public. First, we got to get the infrastructure built, much as we did in the data revolution, much as we did in the building of the highways in across the United States after World War II. You got to build done infrastructure. Once the infrastructure is done, you deliver the product to the consumer. And if you'll understand that division, you can then build your portfolio to profit off the infrastructure build, and then also profit off of the delivery of the product. And the product is artificial intelligence. So I have limited my portfolio to these. Let's see, it's 61 to roughly 53 stocks. So with that, I analyze them in different ways. The first way I do is what is their 3-year growth, average growth of their earnings per share, and I give you that in with each of the tickers. I then say what is their current PE ratio, and how does that? I then divide the growth into the PE ratio, and that gives me their PEG ratio. PEG ratio tells me if it's overpriced or not. If you look at the right here, Apple compared to ACMR. Apple is way overpriced compared to ACMR. Just accept that and move on. Now we have then a 3-year price projection. And what I say here is if the price of the stock grows at the same rate as the projected price of the growth of the earnings, what is the price of Apple going to be in January the 1st of 2028? Well, it's going to go from $250 to $339. And I do that on every one of the stocks. And then I rank them based on that information is who has the greatest growth. And number one, as you can see here, is IREN. Okay? Then I go and I say, okay, now let's take that PEG ratio out of the equation and make them equal and say they all have a PEG ratio of 1. And so now we say, what is the effective rate or price going to be? Well, and if you take the PEG ratio out of Apple, they're going to have a negative 53%, okay? Whereas ACMR is going to have a positive of 293. So, okay, now I look for where is my number one stock, and it's down here. That's Micron Technology, okay? Number one was AEHR. Now it's number 3. Number 1 here was number 2 there. Huh. That's interesting. Let's analyze it another way. Let's look at it and say, what is the fair price of the stock today? And what I'm basically doing, I'm bringing them all down to a 1 PEG ratio. 1 PEG ratio says it's fair price. So Apple with a 1 PEG ratio goes from $250 to 238. So it's 4% overpriced. Whereas ACLS with a 12 or a 1.65 PEG ratio, its price goes from 76 to 174. So it's much better. Let's go and look then at what we were saying. What was our number one stock before? We were looking at Micron. Or no, we were looking at IREN. Now IREN shows up as 13, and Micron shows up as our number 1 most underpriced stock. So now we have 3 means of analysis to give us a point in the direction. Then what I say is, okay, let's just focus on the 1600-meter race, the next 3 years, and give them all a PE ratio of 25. So I'm taking Apple stock down from a PE ratio of 32 to 25, and I'm raising ACLS's PE ratio from 12.6 to 25. And now, who's going to give me the highest rate of return based on them all having an equal starting point today and then giving me the finish line on January the 1st, 2028? And so now Apple becomes my 36th stock. ACLS becomes my 6th. And if I come down here again to iron, it's number 8. And Micron now becomes number 3. Okay, I really like this because what it's saying is we're going to level the playing field. We're all starting at the same starting line, and we're running a mile race. And at the end of the mile race, whose earnings per share grew the most? I like that. No, I don't care who your CEO is. I don't care what your political connections are. I just go and I go to my data and I say, what is their earnings per share going to be on such and such a date, on January the 1st, 2028, multiply that times 25, and who is the winner? Now what I did was I said, okay, I need to do this in a format that gives me the exact ranking. So now what I've done is I've sorted this based on the who's going to give me the greatest return from where they are today to where they will be on January the 1st. And shockingly enough, there is HP. And again, you can see why, because its PE ratio was boosted from 11 to 25. On semiconductor, PE ratio was boosted from 16 or 17 and to 25, and Micron from 11. Okay, so now you see, if all things are equal, and all we're investing in is the company who is going to be able to increase its earnings the greatest, if they all have the same PE ratio, we have it there. Now what I think is important is saying, okay, based on this information, how many of them showed in the top categories in all 4 of my ratings methods? And the number 1 is, here's Micron Technology, here's Intel. Now this, is dependent if they get their act together. Another number 4 is GTLS. That's the stock company name is Charter. And then AMD, and then Uber. And if you want to know why Uber's up there, it all has to do with autonomous automobiles. And so that gives you those that achieve a high ranking in all 4 of the categories. Now then, here are those who achieve a high ranking in 3 of the categories. That's on semiconductor. We come down here. Ultra Clean, UCTT, again, a semiconductor company that is going to show some tremendous growth. And then ASML, I just did a video yesterday explaining to you why ASML is a company you want to own. And then NVIDIA. So with this information, and then with the fact that it changes as the price of the stocks change, I can look at this and say, who are the stocks that I want to create a good, solid position in over the next 6 months, because the end of the race is January the 1st, 2028. Now, the end of the other race is January the 1st. What would that be? 20 years from now, 2045. That's where the AI is going to be delivered to me. And that's where I'm going to see those companies who are positioning themselves to deliver AI to me. And I can tell you off the top of my head who they are going to be. That's going to be Apple, Google, Amazon, Microsoft, Meta, and Tesla. Now, why is that? It's because they're spending the money not to build the infrastructure. Well, yes, in some ways they're supplying their data centers, but they're spending the money today to charge you $19.95 a month and then raise it to $29.99 after 2 years and then to $39.99 after 10 years. They are the people who are going to deliver AI to you over the next 20 years. So that's how I analyze it. And I break it down so that I can understand it. And then I try to explain it to you so you can understand it. And then I put it in front of you so that you can digest it. And then over here, I have to explain this. This is my deep dives. I just did a deep dive today on AEHR. Let me go over to my sheet number 1. AEHR is where is it? Right there. Just did a deep dive today because it's up over 24% today. And I know why, but I wanted Brad and Samantha, those are my AI agents, to explain it to you, to explain what happened and why this stock isn't stopping where it's at. And it needs to be in your portfolio, and you can understand why. Now, it's only in one of the categories, but you need to, when you see a stock that moves, you need to understand why. Now, the same situation is when you see a stock that, and I cut my holdings in SoundHound in half today. I was up over 100%, and I took my profits. And the reason I took my profits are explained in this deep dive. That's what I give you. I charge you for it. As I said, I spend about over 20 grand putting this whole program together, paying my people, buying the data, paying for the software, whatever, and I charge you $19.95 a month. And I'm willing to prove it to you. I'm willing to give you a 14 days to surf my research and come away and say, does he know what the hell he's talking about? Does this really make any sense? Can he guide me through this maze at a cost of $19.95 a month so that I can become a millionaire? I think I can make you a millionaire. If you got enough money to invest. And what is that going to take? It depends on your age. If you're in your 20s and you can muster up $6,000 or $7,000 a year, whatever it is right now that you can put in a Roth IRA, I'll guarantee you, if you'll pay attention, you'll be a multi-millionaire when you retire at 65 or whatever the retirement age is when you get there. So that's what I do to entertain myself and to grow my family wealth. So I invite you to take part of it. I'm a retired financial advisor. I've been in the financial industry for many years. This is cutting edge. This is what you pay an analyst $500,000 a year to do, and then you put him on a bonus that if he exceeds the S&P 500, he gets a percentage bonus on top of that. This is what Goldman Sachs pays its most intelligent computer engineers to do for them. And I'm making it available to you for a whopping $19.95 a month. Make your decision. I mean, it's your decision. We'll just leave it at that.